On the surface, it looks like the Federal Reserve has managed to pull off the impossible. For years, they waged a relentless war against the inflation that was crushing family budgets and dominating headlines. And at a first glance, it seems like they won. Prices have cooled, fears of a wage price spiral have receded, and a quiet sense of relief has settled over Washington and Wall Street. But what if that victory wasn't really a victory? What if, in their single-minded focus on putting out the inflation fire, the Fed inadvertently created a trap? Today, the central bank, and by extension all of us, are staring at a difficult choice. A choice that could either force the economy into a deliberate crash or unleash a new, more dangerous wave of inflation. Your savings, your investments, and your financial future are all caught in the middle of this dilemma. So the question is no longer just about what the Fed did, but about the consequences of what they might be forced to do next. To understand the trap the Fed is in, we first have to appreciate the battle it just fought. It wasn't that long ago that inflation was the primary topic of conversation in the country. After decades of price stability, the post-pandemic world created a perfect storm. Supply chains were snarled, government stimulus flooded the economy, and a surge in consumer demand sent prices for everything from used cars to lumber soaring. For a time, the official line from the Fed was that this was all transitory. But as the months went on and prices kept climbing, that story became harder to believe. The pressure on the Fed, led by its chair, became immense. Their core mandate is to maintain price stability, and by that measure, they were failing. So, they acted. The Fed embarked on the most aggressive series of interest rate hikes since the early 1980s. The goal was simple, if painful, to make borrowing money more expensive. By raising the federal funds rate, they increased the cost of mortgages, car loans, and corporate debt. The idea is to cool down demand across the economy, slow spending, and give supply a chance to catch up. In other words, it's a form of economic chemotherapy, a poison designed to kill the disease of inflation, even if it makes the patient, the economy, sick in the process. And on paper, this strategy worked. After peaking at multi-decade highs, the headline inflation numbers began to fall. As of the latest data for June 2026, the Year-over-Year Consumer Price Index, or CPI, was reported at 3.5%. That's a world away from the crisis levels that sparked the rate hikes. The narrative shifted to a cautiously optimistic, soft landing. It looked as if the Fed had stared into the abyss, hiked rates just enough, and was about to guide the economy to safety without causing a major recession. It looked like their strategy had been vindicated. But as we're now discovering, winning that battle may have set the stage for a much larger problem. The problem with the Fed's apparent victory is that it didn't happen in a vacuum. And to see the hidden cost of their strategy, we need to look across the Atlantic at their counterpart, the European Central Bank, or ECB. While both central banks face the same global inflation surge, their responses and the results have been quite different. Throughout 2024 and 2025, while the Fed was holding its ground and keeping rates high to ensure inflation was truly defeated, the ECB began changing course. Facing a different economic picture, one with a greater immediate risk of recession, the ECB started to cut interest rates earlier. This created a major divergence in global monetary policy. As of July of 2026, the ECB's key deposit rate stands at 2.25%. In contrast, the Federal Reserve has held the federal funds rate in a target range of 3.5 to 3.75% for most of the year. Now, this wasn't necessarily the Fed being wrong, it was a deliberate choice. U.S. inflation had proven to be more stubborn than in Europe. On top of that, the Fed operates under a dual mandate. It's required to pursue both maximum employment and stable prices. This often forces it into a more complex balancing act. So, the Fed chose credibility. They wanted to send a clear message. We will not let inflation get out of control again. By holding rates higher for longer, they were determined to crush any remaining embers of inflation and, more importantly, to keep inflation expectations anchored. They could not afford to declare victory too early, only to watch prices surge again. But this decision came with a large, unseen cost. By keeping policies so tight for so long, the Fed burned through its room to maneuver. While the ECB had given itself a cushion by cutting rates, the Fed had painted itself into a corner. They had achieved credibility, but they had traded away their options. And just as they were settling into this policy stance, the walls of the trap they had built for themselves began to close in. The Fed's lack of flexibility wouldn't be such a major issue if the U.S. economy were on solid ground. But it isn't. It's standing on a mountain of debt, and the Fed's own policies have made that mountain far more dangerous. It's important to understand the mechanics here. The Fed does not create the national debt. That's the job of Congress and its decisions on spending and taxes. For decades, those decisions have led to massive deficits, pushing the total U.S. debt to staggering levels. However, the Fed's policy determines the cost of servicing that debt. When the Fed raises interest rates, it doesn't just get more expensive for a family to get a mortgage. It gets more expensive for the U.S. Treasury to borrow money. This is the second turn of the screw in the Fed's trap. Their fight against inflation required high interest rates. But those same high rates are now fueling a fiscal crisis. According to recent projections from the Congressional Budget Office, or CBO, net interest payments on the national debt are projected to surpass $1 trillion in fiscal year 2026. That's $1 trillion not spent on infrastructure, research, or defense, but just on interest. In fact, these payments have already grown so large that they have surpassed spending on national defense, and projections show they are on track to exceed Medicare spending by 2028. This isn't just an accounting problem. This is a doom loop. High debt forces the Treasury to issue more bonds. To attract buyers for this supply of bonds, interest rates may have to stay high. But those higher rates blow a bigger hole in the budget, which creates more debt, which requires even more borrowing. The very tool the Fed used to fight inflation is now dramatically worsening the nation's underlying fiscal problem. It makes the entire system more fragile. Just as the Fed settled into its difficult position, pinned down by its own high-rate policy and the exploding debt it was fueling, a new storm has begun to gather. This is different from the last one. The inflation of the early 2020s was largely a story of overwhelming demand hitting snarled supply. The solution, though painful, was to use rate hikes to crush demand. But the new inflationary pressures emerging in 2026 are what economists call supply shocks. This isn't about too much money chasing too few goods. It's about the fundamental availability of those goods collapsing. We are seeing this play out in real time, as escalating geopolitical conflicts in the Middle East threaten major global shipping lanes and energy production. This is a profound problem for the Federal Reserve because its primary tool, interest rate hikes, is almost completely useless against this kind of inflation. You cannot lower the cost of shipping by raising the federal funds rate. In fact, trying to fight a supply shock with rate hikes can be catastrophic. A supply shock is already, by its nature, stagflationary. It causes both economic stagnation and inflation. If the Fed responds by raising rates, it does nothing to fix the supply problem, but it doubles down on the economic pain. It's like trying to fix a broken leg with cough medicine. This is the final wall of the trap closing in. The Fed successfully fought a demand-side inflation problem. Now it may be facing a supply-side inflation problem, and the weapon that worked so well before is now the wrong tool for the job. This combination of factors, the loss of policy flexibility, the exploding national debt, and the rise of new supply-side inflation, has left the Federal Reserve trapped. They now face a terrible choice with no easy way out. There are essentially two paths in front of them, and both lead to a world of pain for the American economy. Path number one is to defend credibility at all costs. In this scenario, the Fed sees the new wave of inflation and decides it cannot blink. After spending years rebuilding its reputation as an inflation fighter, it cannot risk letting inflation expectations spiral out of control. So, they hold the line. They keep interest rates high, or even hike them further, to prove their resolve. This would be a deliberate choice to prioritize crushing inflation, even if it means knowingly pushing the economy into a deep recession. Businesses would fail, unemployment would surge, and the stock market would likely suffer a significant crash. Path number 2 is to support the economy and risk inflation. In this scenario, the Fed looks at the fragile, debt-laden economy and decides it cannot possibly tighten policy. They see weakening growth and decide their mandate to support employment takes precedence. So, they pivot. They begin cutting interest rates to provide relief. But this would be a monumental gamble. By cutting rates in the face of rising supply-side inflation, they would essentially be waving a white flag in the inflation fight. Pumping more money into an economy where goods are already becoming scarcer is a textbook recipe for prices to explode. This could devalue savings and cause the cost of living to skyrocket. So, did the Fed get it wrong? The answer is more complex than a simple yes or no. It can be argued their decisions were logical based on the information they had. They chose caution. They chose to prioritize credibility. But those choices have led us here, to a moment of extreme fragility. The Fed isn't necessarily wrong, but it is trapped. Trapped by its past decisions, by unsustainable fiscal policy, and by new global shocks it cannot control. For the average person, this isn't an academic debate. It's a warning light. It means the relative calm we've seen may be deceptive, and the ground beneath our feet is less stable than the headlines suggest. Understanding this trap isn't about predicting the future. It's about recognizing that the risk of a major economic event is now significantly higher. The path forward for the Federal Reserve is narrow and treacherous, and for the rest of us, navigating the fallout will require more vigilance than ever before.